Hey everyone, Josh Vollmar here. Thanks for tuning into this April 2023 fertilizer market update. I want to start off by pulling up this composite, and this is something that the Andersons has maintained for over 20 years, and it just shows the price of fertilizer, a basket of fertilizer products against the price of corn. So you've got green equaling fertilizer, red equaling corn. And so the key thing in this chart is to recognize that the fertilizer composite basket is now back to the long-term trend line. And so if we narrow in and just look at the period since 2020, you can see that we have finally come below that trend line. And if you go back and look at just where we've been over the last 12 months, that composite fertilizer basket was costing almost $900 a year ago, and now it's almost half that price. So if you take that same composite fertilizer and look at what it means from a short-term carrying cost standpoint, even though fertilizer is half the price, given where interest rates have gone over the last year, it is costing you just as much to carry that fertilizer. And so if you look at where pricing is today, that $450 average price for the fertilizer basket, and you were to hold product even for a month, it's going to cost you $3. If you were to hold it 6 months, which at this point in the season is pretty unlikely, it's going to cost you $18 to do that. And so interest rates are a factor that needs to be considered at this point. Growers are recognizing this as they're out making investments. And so this is the latest Purdue Ag Economy Barometer survey. And so you can see I've highlighted here the difference in grower opinions. So if you go back to last July, interest rates were starting to be a concern, but now they are the number one reason why a grower would cite for it being a bad time to make a large investment on the farm. Moving on, I want to just talk about how the spring of 2023 from a fertilizer pricing standpoint is starting to look very much like the spring of 2021. So I know this is a bit of an eye chart here, but the key thing to look at here is that the red line, which is the 2023 pricing, is looking very similar to the 2021 pricing, which is the gray line here. And so I'm going to favor this type of chart throughout today's slide deck, and you'll see that pretty frequently to make that point consistent. We're going to start with ammonia today. And so global ammonia values continue to decline as supply appears to be abundant. The April ammonia contract settled at $435 a metric ton, which is about equal to a $395 a short ton value. Midwest terminal values are down almost $200 a short ton over the past month and now sit around $575 a short ton. When you look at today's pricing and compare it to a year ago, it's down almost $900. And so that is almost a 60% decline. So pretty substantial compared to where we were a year ago. And a lot of the driving factor of that is European natural gas prices. So there is a high correlation between European natural gas prices and that Tampa contract and or just global ammonia values in general. And so keep in mind, though, you may look at this and say, oh, this is a pretty bearish chart. But keep in mind that Europe did not have much of a winter this year. And so what happens next year if they do have a winter? What happens if there is a really hot summer and there is additional power generation demand that's going to consume natural gas? And so it's very much possible that European natural gas prices have reached a floor. Looking at U.S. natural gas prices, they are just dirt cheap too. And so here you can see the Henry Hub benchmark is down near $2 in MMBTU on the front month. And so compared to European prices, U.S. nitrogen producers can produce ammonia for about $400 a ton cheaper. And there is no carbon tax in the U.S. as there is in Europe. So a huge competitive advantage on a global scale here. Moving on to urea. Urea moved out of its seasonal range last week. And so from early February through early April, urea had generally been traded in a tight $30 a ton range. And so let's call it $300 to $330 a short ton, give or take $5. And so all of that happened during a period of rapidly declining ammonia values, a weakening cost curve, and an India urea tender that failed to excite many. Last week, though, NOLA urea prices surged, reaching as high as $355 a short ton. So what we've noticed is that NOLA price action has followed liquidity. So high volume equals prices being steady to higher. Low volume equals a price drop. And the market just doesn't do well with liquidity. And so last week we started to see the weather started to turn. You started to see that import values have not really improved that much, and prices started to surge. And so the trade balance would indicate that we still don't have enough urea in the U.S. to support 92 million acres of corn. And this could push tons towards other nitrogen sources such as ammonia and UAN. And I continue to assert that we don't have sufficient supply. And so you're already starting to see this in the southern plains as they've gone to the fields, regional supply outages. So it's possible that you continue to see a short squeeze occur given the amount of buyer deferral that has occurred. I'm going to pop this up. This is a urea chart showing the long-term demand zone. You can see that the price of urea dipped down briefly into that long-term demand zone over the last several weeks, but ultimately bounced out of that. And one thing to keep in mind with urea is that generally urea is the most widely traded fertilizer commodity. And so when urea has a bullish run, it typically has a tendency to have a spillover effect on other fertilizer commodities and generally improve sentiment overall. And so we've gone from this period of very poor sentiment over the last couple of months to sentiment starting to shift a little bit. This chart shows the pricing spread between NOLA and upriver locations on urea. I've used in Cincinnati as an example. The average spread, which is that blue line, is a bit choppy. And so because the price of NOLA urea is very volatile and the price upriver doesn't change every time there's a NOLA price change, I went ahead and smoothed this out. And so if that's that purple line there, and that's just an exponential moving average there. And so you can see that over the course of a fertilizer year, the price or the overall spread between NOLA and upriver locations grows wider over the course of time. And so not that the price of NOLA becomes less relevant as we move into season, but regional supply and demand balances become very, very critical and ultimately determine where pricing goes as we head into season. I want to pop this up. This is corn planting intentions for 2023 from the latest USDA report. And you can see in this scenario, I want to just point out North Dakota in particular. It's got a 27% increase over last year. And so that's almost 1 million acres. And the thing to remember with nitrogen products is not all areas are created equal. And so you've got some areas that use different types of nitrogen. And so generally that northern tier is typically going to use more urea than other supply sources from a nitrogen standpoint. A lot of that area is still covered in snow. And so a lot of those acres are still questionable on whether or not we actually get there from a corn planting standpoint, but still early in the season, only early April at this point. Moving on to UAN, UAN prices have been range bound, neither moving down with ammonia's descent nor rising on urea's ascent. And so urea's 2023 price is hiding behind the 2021 price here. And so the two are really moving in lockstep from that period. Popping this up, this shows two demand zones. So you have this long-term demand zone that had cheap gas and supply expanding during that period. And then now we're currently in this European energy crisis period. So we're at the low end of that demand zone, but certainly holding within it right now. When you look at the barter rate on corn and UAN in Cincinnati, you can see that we are at a historical low, at least for this time of year. And so pretty darn good value on UAN right now. Looking at nitrogen and comparing various nitrogen products, we hold ammonia's price steady here. And then we look at what the premium or discount of the various upgrades are. And what you can see is that both UAN and urea are now at a premium to ammonia. You can see that UAN in particular is trading in its historical premium zone right now. Moving on to sulfur products, the price of sulfur has been steady and range bound. Ammonium sulfate, similar to that, also continues to be range bound. It had been on quite a decline since the summer fill period, but appears to be stabilizing at this point. AMTHIO is a very similar story, limited liquidity as we head into wheat top dress and wrapping that up in many zones, along with getting ready for the pre-plant period. Moving on to dry phosphates, the NOLA dry phosphate market did see a healthy bump last week as warmer and drier forecasts led to some liquidity. Looking at international values on MAP, over the course of the last month, the U.S. has moved from one of the cheapest MAP markets in the world to one of the most expensive. So this is very similar to what we saw last fall when demand kicked in and the U.S. became the most expensive market in the world. Recall last fall how tight supply got, and you could see a very similar scenario potentially playing out this spring if weather conditions permit favorable applications. Here we're just zooming in on this. And so keep in mind, one of the things I talked about last month was how there was limited carryover inventory last fall, and the U.S. is now producing substantially less dry phosphates than we used to, all during a period when we have countervailing duties in place. So given continued weakness in the ammonia and the sulfur markets, which are both major inputs into the dry phosphate industry, The cost curve continues to decline. So, we had these bullish factors, countervailing duties, less production. You also have a scenario here where you have, very bearish factors. You've got a cost curve that continues to decline. And so the wild card here is really what happens with China and Morocco. How much are they going to export this year? With all this in mind, the global trend generally is down. And so it's still advisable to end the season with an empty bin as we approach a postseason price reset. Looking at the price difference between MAP and DAP, you can see that DAP continues to maintain a very unusual premium to MAP, making MAP a much more affordable choice. Right now, we are starting to see some folks start to move over from MAP or from DAP over to MAP. Moving into row starters here. As we head towards planting, you still have time for an in-furrow row starter. The Anderson's Pure Grade is the best-selling brand of liquid fertilizer in North America and the key component in growers' fertility programs. Pure grade low salt starters are field proven, trouble free, and seed safe. When placed near the seed during planting, essential nutrients go to work immediately, powering young seedlings towards maximum production. Going to wrap up here with potash. So potash prices aren't quite half of where they were a year ago, but they are substantially cheaper. So potash has either held steady or fallen in price for a year straight. Notice though that the velocity of the declines are greatly subsiding. So prices are leveling off, and even in a few key markets, we've seen prices increase in the last week. And so the question is, does the losing streak come to an end? The big news last week in the potash market was that India settled a 6-month potash contract with Canpotex and Uralkali at $422 a metric ton delivered. Here's a view of the potash barter rate since the turn of the century. You can see we spent a portion of 2021 and 2022 in the upper 10% of pricing on a barter rate basis. However, we've now returned back to an average barter rate. NOLA potash barge values have traded in a tight $10 to $15 a ton range over the past 2 months, which is also a sign of stabilization. And that has led the pricing spread between NOLA and the Corn Belt to continue to work back towards the average value, which is also supportive of pricing. So that's all I have. Hope everyone is able to get out into the field soon, and hope some of you are able to plant some corn over the course of the next month. So looking forward to catching up with you next month. Thanks for tuning in again.